Madeline and Katrina? Yeah. I'll take that as a yes.
We're good.
Okay, thank you. And is Mike back on yet, or he's still off camera?
He's still off camera at the moment.
Okay. Okay. 5, 4, 3, 2, 1. Good morning and welcome to the Daily Energy Markets podcast. It is Sunday, the first Sunday of November. Of course, first Sunday of every month, we have the pleasure of welcoming two of our top commentators, Mike Muller, head of Vitol Asia, and of course, Christoph Ruhl, senior research scholar, Center of Global Energy Policy at Columbia University. Let's kick off with you, Christoph. This morning, we've had a number of impacts on this market since we last talked. Obviously, the biggest one, at least the biggest event, it's turning out maybe not to be the biggest impact for the market, but welcome your thoughts. The war in Palestine seems to have sort of ended 3 or 4 weeks later as an event that the market has decided is neither a supplier or demand disruptor. Your thoughts 1 month into this crisis?
I think, am I still online?
Yes, you are.
Okay. I think that when you take the multitude of crises we had before, including from Ukraine onwards, and then add to it the latest war there in the Middle East, I think the truly amazing thing is that how steady oil markets are. I mean, remember, we are in a world where oil supply is being cut to just keep prices higher. And we have little fires everywhere, and including in the major oil producing region of the Middle East. And the oil price sort of barely hovers around 85 to 90. And that is sort of, I think, a very big both sign that we are really well supplied with oil in the longer term, in the medium term, and also a sign of how the world has changed. And it's unthinkable. I mean, you can't compare it really. I think that is true. People say you can't compare it to the situation 50 years ago, simply because oil supplies globally have become so much more diversified, and because everybody knows that the US is now energy independent and can change its habits and its attitude, and because shale has changed the world in pretty much the ways thoughtful people had predicted and expected, and many other people had just talked about without really realizing it. And that's what we are seeing when oil prices don't explode after a traumatic event like that. Now, what would it take to change that and for oil prices to really become a problem for the global economy? I think a lot more than we see it would take physical supply disruptions which are recognizable as not being immediately fixable, such as a physical attack on the Strait of Hormuz, or burning ships, blocking seaways and stuff like that. Because what also has happened, and this now in the shorter term, there has to go some credit to the Biden administration. They have managed pretty well to diffuse all sorts of geopolitical crises and tackle them head on without major disruptions to the global economy. So what has happened in the background is that we seem to come through the cycle increase in interest rates and moving toward really a soft landing in the US, despite the ruckus in China and all of that. So the global situation for the economy has remained sufficiently stable to allow this kind of diplomacy to be deployed and to smooth each other out. And despite all the criticisms here and there, I mean, I shudder to think of what would have happened under the previous administration had they been confronted with a multitude of crises like we have seen.
Well, they certainly seem to have in this particular Middle East crisis, that they've maintained the contagion spread. But let's bring in Mike Muller, head of Vitol Asia. Mike, the Brent crude traded, closed last week, 84.89, under $85 a barrel. Again, the same question to you. The markets seem to have come to the point of view that this is a non-event really for the oil markets and for traders and pricing of oil. What does it mean then that the downward sort of flow is the sort of neutral position is downward, not the neutral position is upward, that the market wants to decline once it removes the geopolitical risk?
Yes, I think describing what's going on in and around Gaza as a non-event, of course, is probably taking things a little too far. There
absolutely. I mean, I have to. You're absolutely right. It is a major event. It is a major event, and of course, a major tragic event of human life loss. No doubt. I take your point 100%.
No. I mean, official data pushing 10,000. This is very serious. But I think there is still some, but maybe not as much risk premium associated, because, of course, there was the potential for the situation to escalate out of hand, with potentially more than one front of activity the Israelis would be confronted with. And I think it's fair to say, I guess, that some of that risk premium has gone out of the market, just because we've now had 4 weeks and a few days elapsed since the initial Hamas action on the 7th of October. And as a result, the market has concluded that risk premium can shrink. There is, of course, also a risk premium in the gas markets. We mustn't forget that there's a lot of gas produced offshore in the Levant area between Israel and Egypt and Cyprus. And there have been some losses there as well, of course. But I think the backdrop is still one of concern over global economic welfare. There was a headline, I think, in your digest, one of your 10 headlines, about a massive container company laying off some staff.
AP Moller Maersk laying off 10% of its staff because container shipping down.
And I mean, it's reporting season, and whilst the energy giants have reported reasonably creditable results, the concern remains about global trade. And I think it's not just the container sector, but general concerns about how much money the Chinese central government is throwing by way of stimulus at the economy in order to maintain the metrics they wish to see. There are some out there that do feel that the GDP growth rates in China will take a lot of helping in order to maintain themselves. That, of course, then reverberates around the planet. So then the question is, what's happening at the very front end of the market? And I think in one of your midweek podcasts, one or two of your commentators observed that there's a fair bit of spot oil around in certain pockets, which are liquid price discovery points in the Atlantic Basin. And you then have to marry up, why do we have healthy refining margins? Why do we have $85 Brent, and yet we have a lot of surplus oil at the front of the market, and yet we still have a strong backwardation in the market? So I think traders are less concerned than they were perhaps a month ago about requiring a bit of oil at the front of the market. And likewise, governments who look at strategic petroleum reserves might have stepped in and acquired some of those reserves, and there's been very little evidence of that going on as well. I think it is fair to say that there was some extra interest in the initial days to secure oil outside of Hormuz as opposed to inside of Hormuz. But again, that risk premium has also dissipated.
Christoph, the other sort of major development in the last month since we last talked, it would appear that the fat lady has sung, so to speak, in terms of the rate rises that we have sort of reached the end. We're sort of with the punctuation at the end of last week on the jobs numbers in the US, and the idea that obviously the Fed paused last week, as did the ECB, and then the numbers on the jobs markets indicated that the forward guidance would be, from the markets at least, that this is now a plateau situation. I'm wondering what your reading is of the developments of the last month, of the tightening cycle ending, and what it means telling us going forward.
Well, it's really two major trends. One, so for months I hear the story that oil prices go up. It hasn't happened. That, I think, was recognizable and well predicted. At the same time, for months we have this yo-yo game of interest rates will further rise. No, they will not. Yes, they will. That's much harder to predict, because for the time being, at least, central banks are still trying to stick what they call data dependence and giving forward guidance. And what that really means is that they're sticking to models which have not shown to be very accurate or helpful. And they stick to a mental attitude which still believes that when they say 2% long enough, the markets will believe 2% eventually, which has also sort of broken down in the last few months. But what is the truly amazing thing when you look at the economy in its own terms, I think we are really close to what may be called a soft landing in the US. Activity levels remain high. Yes, there are pockets, but it's very typical container workers being released after all these supply disruptions, and they were in very high demand, and now system adjusts. So yes, we have a good situation in the US. Yes, Europe is in a recession technically, but Germany is in a recession now for I don't know how many quarters, and I still can't get a plumber if I need one. So this is pretty the kind of recession we talked before about the US that give me a certain like that with this kind of unemployment any day. It's much better than previous periods of so-called booms. And most importantly, other than the US adjustment, is what happens in China. And while it has materialized what many have expected, that GDP is now closer to 5 than to 10, and this will not go away. And while it is true that they have maybe 5, 6 real hotspots in their economy, from municipal debt to property markets to zombie banks, which can flare up any time, it would be a disaster if they flare up together. It seems also be true that, number one, the extinguishing the fires one by one works for a while. It's not a disaster situation. They're not flaring up and not likely to flare up altogether all at once. And secondly, they still have the means of a massive monetary stimulus, which they didn't use during and after COVID, different from Europe and the US. So even if the macro situation really goes down to 1% or something bad happens, either by itself or because of a confluence of crises, they have the kitchen sink still in their hands to throw at it. So even there is reason for sort of optimism on the basis of an adjusted baseline, or optimism in the 5% or 4% range, not the 10% range. That may not be for oil markets what used to be expected, and it adds to the excess supply situation which we have, and further will support the first trend of oil prices trending lower if they are allowed to. But overall, as an economist or as a consumer and not an oil investor, I think this is a pretty benign picture compared to what we had 6 months ago, what we expected. Much
Mike,
of it by accident, but still.
Mike, just picking up on that China outlook, all things being equal, China demand remains fairly solid, maybe not growing as was forecast at the beginning of the year at very big numbers, but nonetheless, it's still at a solid import level. What's your outlook now as China kind of moves into the winter peak demand window and the sort of China New Year coming up in January?
Yeah, perfect question. I think we have to remind ourselves, this is the time of year when demand in Asia peaks, but demand in the Western Hemisphere tends to ebb to a low because of less driving activity, winter conditions, etc. But what we see going on in China is quite interesting because the fuel sale data on a weekly basis does not really show evident signs of economic weakness. Diesel sales are in line with expectations. Jet demand is indeed robust, exceeding expectations. Singapore Airlines just laid on 5 extra flights a week from Singapore to China. They don't tend to do that unless they're confident there'll be passengers on those seats. And it's only really gasoline that's shown a steeper than expected dip in October, but there's a reason for that. There was a public holiday Golden Week. But the one thing that has happened in China that's quite notable is that refining margins have dropped to the lowest levels we've seen in a very long time, and certainly the lowest level this year, in some cases bordering on the negative. So why are Chinese margins negative? I think the explanation is that runs in the third quarter, which were 1 million barrels a day more perhaps than the same time last year when we still had COVID. So always difficult to compare, but they were likely a response to high demand expectations that were possibly unreasonably high. And at the same time, I guess there was a bit of destocking going on. And as a consequence, now we've seen all this translate into higher than expected stocks. And if the stocks are unseasonably high, the only consequence is that you push domestic prices down, you push refining margins down, and you force run cuts. So it goes without saying that China will either need to continue running its refineries and building stock at low margins, or that there'll be a drop in runs, and that'll manifest itself into lower appetite for crude. And that's highly visible since China is such a significant global importer of crude oil. And I think those are the signs of softness that the market's been detecting.
Sean, can I
please jump in, yeah.
There's an interesting story there, because recall that Chinese oil demand crude oil demand has remained very strong. And a few weeks ago, there were people going around saying there's a decoupling because the economic growth is pretty weak, which is usually the main determinant of oil demand. And crude oil demand is fairly strong. So how can that be? And the answer was that a confusion between net and the gross numbers, because China ratcheted, as Mike has indicated, ratcheted up its refining a lot and its product exports a lot. So they imported a lot of crude to re-export it in the form of products. And some of that, a lot of that probably, of course, came from Russia and were accordingly cheap. So they could do that internationally. Now, globally, when you look at the market as one big pool, then taking for one country taking in more crude, exporting more products wouldn't do anything except put pressure on prices, because it would just not change the total supply, right? But if nobody else exports less products, in that particular circumstance, as China ratcheted up its product exports, Russia ratcheted down its product exports. Because remember, they had this thing that they needed lower prices domestically and therefore exported less, particularly of mazout, of diesel. And that has come to an end. Russia is now exporting again. China was still exporting, and that puts price competition in the global product market and puts refining margins in China down and stocks up. So to me, that's sort of the final dot confirming that there was nothing special about decoupling or any other thing. There was just a market opportunity the Chinese took by importing a lot of crude and turning it into exports and exporting it in a market with cheap crude, which was good money to be made. And that has run its course now, with demand not exploding and with Russian exports resuming.
I wanted to sort of connect all of these dots, Mike, going forward. We've got in the U.S. Congress the sort of debt ceiling issue coming, but the Biden wants to connect the financing for Israel and for Ukraine in the one packet. The Congress wants to separate it. So I'm wondering where the geopolitical risk returns into this equation as these events sort of cross over, and also the issue that we saw over the weekend, the first real crack in the position of regional Middle East countries and the United States. The pan-Arab position now has become a lot more vocal, calling for a ceasefire on the Gaza. And so in the public call for a ceasefire and that not being listened to, then what is the consequence of that journey if the Middle East countries seek a ceasefire very publicly and it's not adhered to? Do they ratchet up the position there? So I just want to tackle those few things before we start. Maybe start with you, Christoph, on that. Looking at with Ukraine President Zelensky over the weekend saying, that all the attention has been taken away from the Ukraine crisis. Your thoughts on that piece and the U.S. funding and the European funding for that?
I think the Middle East has also changed a lot over the last few years. I think at the moment, no one really had an interest in an escalation of the situation, very different from 2, 3, 4 decades ago. When you look at it, the Gulf states, their political weight, their economic weight in the Arab world has increased compared to countries which are less, inclined to be moderate, like Syria. And they were in the process of putting some durable efforts at creating a peaceful region in there, by reconciliation with Iran and also by reconciliation with Israel. So that happened, and they are not really interested in, I think, the Middle East once again going up in flames. Even Iran, for all its sins, has benefited from it, has seen its sanctions being relaxed, has played its favorite thing, two-way game with selling drones to Russia and negotiating with the US on sanctions, and with Saudi Arabia on embassy exchanges. And so that's a situation for maximizing the benefits of diplomacy, not for burning everything and risking the nuclear facilities get bombed again and all of that. And to my mind, even Nasrallah's speech and Hezbollah, as my wife always says, they will never make an announcement that they do something on such and such a date. But when you listen to that speech, at least to the excerpts available, was pretty dovish, saying, "Oh, we got surprised." And so it seems the worst possible time now on that front for Hamas to suffer the consequences, or for the people in Gaza, I should say, to suffer the consequences leveled upon them. Something very bad has to escalate a lot more than in the past for Arab governments to follow the street, so to speak. At some point, they have to follow their domestic audiences. They can't just go along with everything Israel would like to do. But so far, the patience has been quite notably. And on the other hand, when you look at the Russia and the Ukrainian crisis, which you mentioned, I think the one big beneficiary of this whole situation, obviously, is Russia, which is sort of away from the headlines and which can wait and see, and almost any which way it will turn out. Russia will not lose, will remain its fingers in the pie, will remain its weapons deliveries, its Wagner people in Israel to be connected in Syria and connected to Hezbollah. Will probably lose some of its surface ties with Israel, but even that can be fixed given the number of Russians in Israel. So that's a pretty clear winner. The Ukraine, I don't think that they will suffer consequences immediately, but if the war situation doesn't change, I think still it's more a function of the sluggishness of their offensive and the stalemate which people get tired of than of what happens elsewhere in the world. So the withdrawal of support is not immediately on the order of today's agenda, but it is slowing down, the not ratcheting up of support has been on the agenda since before October 7, and is likely to move up there.
Mike, just bringing you on the same thing, looking at it from the perspective of the oil markets and the geopolitical risk. Do the events of the last few days, the sort of meetings with this sort of splinter between the Arab countries and America, the position, the big speech by the Hezbollah leader last week, does this indicate that the possibility of a return of geopolitical risk into the oil price, or is it still a neutral posture, do you think, going forward?
Very many questions here. I think without a doubt, the speech from the gentleman in Ramallah was reassuring in many ways, because it wasn't quite as bellicose as maybe some had feared. But we have to remind ourselves, and Christoph's already touched on this, the region was heading towards some very exciting developments. Many leaders in the region have made open their dream, their ambition of turning the Middle East into a leadership position. The Emirates are hosting COP28 later this month. And there was a peace process going on, which was resulting in a rapprochement, not just between Israel, the Emirates and Saudi Arabia, but between those countries and Iran. And many at the time said that
that point on that between Saudi and Iran obviously was shepherded by China. Does China have a position on all this? I mean, very quiet, or do they have influence?
No, I'm sure behind the scenes. I mean, I've not seen, and maybe I've just missed the evidence, but I'm sure there's plenty of diplomacy going on or in the works there. But back to your question on the US, I mean, there are a few things that are happening concurrently with this backdrop of a strong desire for this event that has the potential to scar a nation for an entire generation, not just a nation, a region for an entire generation, to be contained as quickly as possible, because the deeper it goes, the more difficult it will be to realize dreams like the economic success around developing infrastructure such as NEOM, for example. I think a bunch of things this week on the part of the US have also sort of drowned in the background, but they're quite important to look at as well. I mean, for example, there has been an extra round of sanctions imposed on Russia to further tighten the conduit of goods via those channels that the G7 wished to see clamped down upon, and a few high-profile upstream producing entities have been added to the list of entities that are sanctioned. At the same time, General License 44, which essentially opens the taps for Venezuelan exports, is a very significant step to cool oil markets, which is clearly a priority for the Biden administration also. And how that oil works its way into the market is yet to be seen, because there are three issues, of course: the infrastructure, the actual ability to produce, and the channels whereby the monies flow. And we must remind ourselves, a lot of countries and companies are owed billions by Venezuela. But the logic would dictate that those streams from Venezuela would flow to the US and thereby release other grades of crude for Asia, rather than those grades traveling all the way to Asia as they have done now. And then, of course, there's the very delicate tightrope that Blinken's been treading, which we've been watching all weekend, which I don't think anyone's going to be happy with the outcome, because there's a big swing of consensus, of course, across the Arab world, where you're sitting, Sean, to see some sort of diplomatic solution found to stop any further escalation and bloodshed.
And not just diplomatic found, but found quickly. The patience, I think this is the question I'm kind of struggling with of its impact, that the call is really imminent, rather than, do what you can over the next month, and that divergence, I think, starts to become a question over the coming days, maybe even weeks, certainly. Let's go to the survey question and just wrap up our discussion this morning on all things OPEC, of course, meeting at the end of this month before we get the chance to talk again. So the oil market is taking Mideast conflict in its stride, as it looks to be neither a significant demand or supply disruption event. You could have put the words in "thus far" there, but nonetheless we didn't. Christoph, OPEC Plus are due to meet in the coming weeks with the outlook for the first quarter. The Saudi Arabia voluntary cut of 1 million barrels a day and the other pieces that add up to this supply curtailment by the major oil exporting group. Your thoughts on how they come into this month, what they need to base their decision on vis-a-vis the extension of all these cuts into the first quarter?
They will extend their cuts most likely, and if only this has become probably stronger now because it takes a warning signal a little bit. You can't do everything and go on and expect no reaction from the Arab world at all. Linking the politics to oil, whether one likes it or not, that's likely to happen. I personally look forward to their research department changing their demand forecasts. I think they will have to adjust that sooner or later. But that, of course, the demand is going to be lower than what they expected, also indicates the need for continuing to implement the cuts. And otherwise, I think in situations like that, they know that it pays to be quiet. There's not much one can say really as an oil producer association or as a China. And as we see things developing, I also want to say that in the long term, probably the big loser for that will be Israel. If their government goes on like that, playing to its own audience, then that's pretty short-sighted, I have to say.
Mike, your thoughts on the OPEC Plus outlook decision this month, and of course the Saudi voluntary cut of 1 million. In conjunction, Mike, with the idea of what it means to Asian, if we have reached plateau rates, then the dollar weakness, the dollar strength we've seen comes off, and maybe that's a bit of a relief for Asian importers, and also gives OPEC Plus and Saudi a bit more space. Your thoughts on all of those issues going forward?
I'm not sure that much has changed, other than what I said about China, where there's been a bit more domestic stock building than perhaps the market expected, but against the backdrop of decent demand. I mentioned diesel, but I mean power demand in China has been pretty robust also. So that combined with a bit of uptick in aviation means there's scope for some upward revisions in certain segments of China. But I don't think there's a significant encouragement in the form of extra demand or supply going missing anywhere that would cause Riyadh to change tack.
What about the carrying? At the end of the day, this is, Mike, a big extra burden for Saudi. We're seeing their budget deficit now being published and a decline in revenue. I mean, 1 million barrels a day off the market is a very big bucket for them to carry for everybody else. Does that sustain? Is there any sense that others, they may not be willing to carry that bucket for much longer as Guyana grows its capacity, as Venezuela comes back, and so forth?
I think all that is in their balances already. I don't think there are any surprises. So if anything, history shows us that the bringing on stream of new projects, be they refineries or be they oil fields, tend to be beset with delays. So I mean, whether or not every single one of the offshore projects in the Atlantic Basin will be on time as scheduled next year remains to be seen.
And vis-a-vis any demand destruction at these price levels, Mike, going into Asia winter peak, any signs there, or the Asian economies can handle this $85-90 oil through the coming quarter?
I think the significant economies are pretty robust and able to handle price in the 80s. Not least as articulated by His Excellency Minister Hardeep Singh Puri of India, who stated at ADIPEC that 80s is just fine for India, they can afford it. I believe that's what he said.
Remember, we had a period of high inflation, so 80 today is not what it used to be 10 years ago.
No, clearly, and I think that's part of the underlying argument here by the Saudis and OPEC Plus that $85-90 oil is manageable by all parties, consumers and producers, and it's the neutral spot, if you like. At least that's what it seems to be, even with the drama of all of these geopolitical risks. That price, although I think there's something to pay attention to over the coming month, that the natural posture at the moment does seem to be a falling oil price, all things being equal, that the price has got some sort of downward draft on it, and obviously one can find reasons to back that up. But that draft downwards, I think, could continue with all other things being neutral, and how much, you know, we're propped up by the you know, from the June low of nearly $70 Brent with the 1 million barrel a day Saudi cut, that being announced again through the first quarter would probably give it an $85 floor. But there does seem to be a downward draft, and we'll have to watch where that goes. Christoph Ruhl, as always, thank you so much. Have a great month. And also Mike Muller in Singapore, thank you so much for your insights today, and for all of you guys, and obviously Christoph in particular, getting up early, bright, and managing his babysitting duties at the same time. That's the nature of things. Thank you very much. Have a great day. Catch up with you soon. All the best.
Bye.
Thanks. Bye-bye.
Cheers, guys.